You know, quant investing usually works. I mean, when it comes to their models, they usually work better during these bull markets. How are you adjusting your algorithms now, given the volatility we've seen?
So we're not doing anything different than what we are very well aware. What we are doing is we dissect the market cycle into 4 different parts, and we knew from 2018 that we were entering a bull market environment, meaning that we had adjusted our portfolio allocation strategy 2 years before, and now as of March 6th, we sensed a very strong signal indicating we're entering the first phase of recession. So what we're doing is lowering our equity exposure in our portfolios, and we'd like to be have our clients well positioned to weather out the storm, which we expect to last between 6 months to a year.
What are your retail clients in South Korea asking you the most now? I mean, are they still asking about cash holdings? Are they still asking about the extent of this coronavirus? I mean, what are still the key questions that you have to answer?
You know what's funny? We've been holding about 20% in their portfolios starting last year. So they used to complain that why we were holding so much cash, and now they understand why they did. So less of complaint on the cash holdings, but now they're coming to understand, you know, the different phases of the market cycle, and what they're asking is, so how long will this last? And you know, how would we know that, you know, this is not the worst that we're seeing?
Speaking of your clients, I mean, have you seen a lot of redemption? Give us a sense of the mood among them.
So I was going to get to this before. People need to have a full sense of what they're getting into before things happen, right? So we spent a lot of time educating the clients what's coming ahead, meaning that we have a very little exodus of money going out. We're actually receiving 70% more inflows into our strategy because it's the all-weather portfolio and it's very recessionary proof. But outside of that, what's funny in Korea is people are actually learning lessons. They believe they have learned lessons from 2008, meaning they think this market will recover at the end of the year, and they're pouring money into the fundamental assets that represent Korea, like Samsung and Hyundai of the sort. They're opening up new brokerage accounts, 20,000 new accounts on a daily basis now. It's a craze here, equity craze.
When
so
do you
regardless
expect
of the short-term outlook, people are thinking long-term, but they may be thinking too long of a term without realizing that you're just seeing the beginning of the recession. So my hope is that people stay long-term believers of the market as they set out to be, and they'll be fine at the end of this trying time, which tends to last just a year or two. But before they see the peak-to-peak recovery, you know, it's going to be a very trying time.
Jenna, we talk about how it is pretty much recessionary. I mean, in terms of sectors and countries, what would be the best bet right now?
Right now, it really depends on the asset classes that you're going after and knowing the characteristics of each respective asset classes. So if you're going after the capital preservation in fixed income, of course, developed markets and developed currencies will fare better. But when it comes to equities, you know, equities are in your portfolio for growth. Whereas the growth prospect, you probably won't see much growth for the next 6 months in any region. So, you know, my advice is to diversify your equity holdings as much as you could. And also, you know, you don't have to just throw away everything. You're bound to see recovery, and you need to have your foot in the water.
Jenna, you're also, when it comes to fixed income, you prefer U.S. Treasuries. Is this I guess, assumption that yields could actually head to zero, given what you're seeing with the likes of Germany and Japan and U.S. really seeing that type of Japanification? Or, we're talking about all this massive fiscal stimulus and you're going to have to find a way to fund that. Are we going to see a surge in supply where in the end you're going to be something that's inflationary and then yields are going to have to spike higher?
It could happen. The reason why I think I'm a proponent of Treasuries is not because of the short-term yield differences, but when you hit an extreme case, it will preserve your portfolio value. It's definitely a still viable, I think, extreme cases asset class that can protect your overall holdings. Never mind the short-term volatility. In the end, you're holding that asset for the extreme case scenario.